What is going on, guys? Will here from Real Estate Investment Pro, and today we're going to be talking about ways real estate investors make money. So I've broken this down into three main categories. The first category is cash flow, and what that is it's actually a pretty simple concept. You collect rent or you collect some sort of income. Now that's key, I'll come back to that in a minute. And out of that you deduct the expenses, and whatever's left over is either going to be a positive or negative cash flow number. Obviously we're always going to try and get a positive number there, and that's really the key to real estate investing. That's the core of it, and that's how I make my income. So cash flow is king, remember that. And when I said at the beginning there, it's not just rent, it's also income, because sometimes what can really help make a difference, especially in competitive markets, is when you look at a property, you're not just looking at the rent you can collect. You start to say, well, okay, hey, I've got this extra space, or I have a garage, maybe I can rent that out for storage, maybe I can rent out that parking spot. Or if you have space inside, maybe you look at it, oh, I can reconfigure this one bedroom into a two bedroom and collect more rent. Or I've got an unfinished basement and I have enough ceiling height there, or I could dig down and do a full renovation and add a second, third, or fourth unit to that property. And that's really going to help your numbers. So that's cash flow. Now, the second way real estate investors make money, pretty simple actually. It's through the mortgage paydown. You buy the property, you have a mortgage, so that's in the expense category that we just sort of did a quick overview there, but that mortgage consists of two parts. You have the interest part and the principal part. The interest part, kind of lose that money, yes, you can write it off and so on depending on your state or province. It's the principal part, which is basically like a forced savings account. Every single month your tenants are paying down the property for you, so your net worth is growing, your equity in the property is growing every single month. So hey, that's amazing. Now the third one can be a little bit more complicated, but there's also a huge hidden advantage to this number three: appreciation. Now, what appreciation is, it can mean different things to different people under different circumstances. Sorry to be so complicated, I know this is terrible, but we can have market appreciation, which is what a lot of flippers use. So they come in, they buy a house for, let's say, $1 million, and then they do a little bit of work to it and they sell it for 1.3, assuming they only put in $100,000. So that's 1.3 million minus 1.1. They get to keep the spread of $200,000. Great. Now, I'm not a big fan of flipping houses or relying on market appreciation, because that does fluctuate, and depending on what's going on, you can really be left underwater with the property. I'm a much bigger fan of something that I call forced appreciation. Now, this, you can do calculations and you have a much more reasonable chance of achieving the returns you want. A forced appreciation, let's say I'm renting an apartment for $1,500 a month, but it's a little bit run down or a little bit dated. Well, I go in there and I put in a new kitchen, some new flooring, I put in X amount of dollars. Now I end up getting $1,800 a month or $2,000 a month. Well, I've just increased the cash flow that much, and not only the cash flow, I've actually increased the property value as well. So forced appreciation is huge. That's also the basis of my strategy. I know cash flow is really what makes or breaks whether or not I buy a property, but the forced appreciation is what I do to the property to make it give me a great return. Now, the last thing I wanted to mention here, which is often overlooked and it's going to be a big factor in the near future, is inflation. Now, inflation is actually tied in to appreciation. We've all seen this before. We all talked to our parents and they said, oh, well, you know, when we bought our first home, we bought it for $80,000. Now it's worth $500,000. If I had known that, I would have bought 10 of them. That's sort of how it works, is that the houses appreciate because of inflation. Now, what's happened recently is that the government has printed a ton of money in response to COVID. Now, all that money is going to be circulating around trying to find a home. We've already seen it spike in Canada and Toronto and Vancouver and areas like that, where home prices have shot up. I was expecting to see inflation on other things like consumer goods and food, fruits and vegetables and some other things, but I was surprised to see it translate directly into home prices right away. So that's one thing that we've seen. Now, that being said, that doesn't mean there's not a lot more room to grow. My strategy was to go out and borrow more. So I have whatever cash I have on hand, but I actually want to acquire more debt, because in doing so, I can buy hard assets like real estate at today's value and pay it back in tomorrow's dollars. And tomorrow's dollars, because they're going to be worth a lot less, it's that same scenario where I'm now buying that $80,000 house, and in lesser time, I'm not going to have to potentially wait 20 years. Maybe I have to wait 5 years or 10 years. It's going to jump up to that $500,000 price tag. So that's my strategy there, and that's what ties into the appreciation part. So there you have it. Those are the three main areas that real estate investors make money. Now, if you want to learn a little bit more, go ahead and subscribe. This channel talks specifically about real estate investing. Not only that, you can check out the website, realestateinvestmentpro.com. There I have a free 1-hour webinar which breaks down the 6-step process that I personally use to invest in real estate. Thanks so much for watching. We'll see you in the next video.